Taxes can be one of the biggest expenses for entrepreneurs and side hustlers, but they don't have to be. The U.S. tax code is full of hidden advantages for those who know how to use them. From home office deductions to hiring your kids and leveraging the Augusta rule, there are countless ways to legally reduce what you owe and keep more of your hard-earned money. We'll break down the smartest tax hacks for $2,025 that every self-employed person should know, no CPA required. Best U.S. tax hacks for entrepreneurs and side hustlers. So before we start, make sure to hit the like button and subscribe to my channel. In the world of entrepreneurship and side hustles, maximizing profit isn't just about making more money. It's about keeping more of what you earn. And that's where understanding taxes becomes not just helpful, but essential. In the U.S., the tax system is structured in a way that favors business owners far more than W-2 employees. Entrepreneurs and side hustlers have access to a broad range of deductions, credits, and legal strategies that can significantly reduce taxable income, increase cash flow, and even build long-term wealth. Yet, many small business owners and side gig workers are unaware of these opportunities, often leaving thousands of dollars on the table each year. This article will explore in depth the most effective tax hacks available in 2025 for entrepreneurs, freelancers, and anyone running a side hustle, from common write-offs to advanced strategies, all fully legal and IRS compliant. 1. Understand the power of the business structure. One of the first and most impactful tax decisions an entrepreneur makes is choosing the right business structure. Most start out as sole proprietors by default, but that may not be the most tax-efficient option. Sole proprietorships and single-member LLCs are simple to manage, but require the owner to pay self-employment tax, 15.3%, on top of income tax. However, once your business income reaches a certain threshold, typically $40,000 to $70,000 in net profit, it may make sense to elect S-corporation, S-corp status. With an S-corp, you pay yourself a reasonable salary, subject to payroll taxes, and any remaining profit is distributed as dividends, which are not subject to self-employment tax. This alone can save thousands annually. Make sure to consult a CPA, as S-corps require proper payroll handling and annual filings. 2. Master the art of business deductions. The IRS allows business owners to deduct ordinary and necessary expenses related to their trade or business. This means almost any expense that supports your work could be deductible. Common deductions include home office expenses, internet and phone bills, office supplies, advertising, software subscriptions, travel, education, and even a portion of your rent or mortgage interest. For side hustlers using a car for business, Uber drivers, real estate agents, delivery drivers, the mileage deduction is especially valuable, minus 62.5 cents per mile as of late 2024, with potential updates in 2025. Use apps like MileIQ or Stride to track miles accurately. Alternatively, actual vehicle expenses, gas, maintenance, insurance, can be deducted if they result in greater savings. Be meticulous about keeping receipts and maintaining documentation to support all deductions. 3. Home office deduction, legitimate and lucrative. If you use a portion of your home exclusively and regularly for business, you may qualify for the home office deduction. This is one of the most misunderstood and underutilized tax strategies. The deduction can be calculated using either the simplified method, $5 per square foot up to 300 square feet, or the actual expense method, where you prorate home expenses, such as rent, utilities, property taxes, homeowners insurance, and even repairs. In 2025, with more entrepreneurs working remotely, this deduction offers a meaningful way to reduce taxable income without spending extra money. Just be sure the space qualifies. It cannot be used for both personal and business purposes. 4. Health insurance and medical expenses. One major advantage for self-employed individuals is the ability to deduct health insurance premiums, including those for your spouse and dependents above the line on your tax return. This means you don't have to itemize deductions to claim it. If you pay out of pocket for your medical expenses, consider opening a health savings account, HSA, if you have a high-deductible health plan. Contributions to an HSA are tax-deductible, the growth is tax-free, and withdrawals used for qualified medical expenses are also tax-free, a rare triple tax benefit. For 2025, contribution limits are expected to be around $4,150 for individuals and $8,300 for families. HSAs can also function as stealth retirement accounts if used strategically. 5. The Augusta Rule. Tax-free rent to yourself. The Augusta Rule, IRS Section 280A, allows business owners to rent out their personal residence to their business for up to 14 days per year tax-free. You can legitimately rent your home to your business for business-related purposes, like meetings, training sessions, or content shoots. The business pays you fair market rent, which is deductible to the business, but not taxable to you personally. This can mean hundreds or even thousands in tax-free income annually. To stay compliant, document the purpose of the rental, use reasonable local rates, and keep rental agreements and invoices between yourself and the business entity. 6. Retirement contributions for entrepreneurs. Retirement planning is a powerful tax strategy. Entrepreneurs can use tax-advantaged retirement accounts to reduce taxable income, while building wealth for the future. The most popular options include Solo 401, ideal for solo entrepreneurs with no employees, aside from a spouse. In 2025, you can contribute up to $66,000 or $73,500 if you're over 50, combining employee and employer contributions. STP IRA, great for simplicity and can be set up even after the tax year ends. You can contribute up to 25% of net earnings from self-employment, with a cap of $66,000. Roth IRA or traditional IRA, these offer more modest contribution limits, $6,500 or $7,500 for those over 50, but can still provide meaningful tax relief, especially when paired with higher income plans. Each plan comes with different rules, deadlines, and tax implications, so it's essential to evaluate which aligns best with your income level and business structure. 7. Hiring your kids. If you have children under 18, you may be able to hire them to work in your business and pay them up to $14,600 in 2025, equal to the standard deduction tax-free. This strategy allows you to shift income from your high tax bracket to their zero tax bracket, while also giving them valuable life experience. Wages must be reasonable for the work performed. Common tasks include social media support, product packaging, filing, or helping with content creation. If you operate as a sole proprietor or a partnership with your spouse, you are not required to pay Social Security or Medicare taxes on those wages. The child can then use the income for savings, education, or even fund their own Roth IRA. 8. Track every expense and use smart tools. The biggest tax hack of all is simple: track everything. Many entrepreneurs miss deductions because they fail to record small, consistent business expenses throughout the year. Use tools like QuickBooks Self-Employed, FreshBooks Wave, or Expensify to automate expense tracking and categorize spending. Link your bank accounts, scan receipts, and regularly reconcile records. Not only does this simplify tax time, but it also helps you understand the financial health of your business. Clean records are also crucial in the event of an IRS audit. Well-documented deductions are much more likely to be upheld. 9. Pay estimated taxes quarterly. If you're self-employed or have untaxed income from side hustles, the IRS expects you to pay taxes quarterly. Failing to do so may result in penalties, even if you pay your total tax bill by April. Use Form 1040-ES to calculate your estimated taxes, and set calendar reminders for the due dates, typically April, June, September, and January of the following year. Tools like TaxAct, TurboTax Self-Employed, and online calculators can help estimate amounts. Paying quarterly helps you avoid penalties and spread out your tax burden, making it easier to manage cash flow. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.